we are going to talk about tax planning, record keeping for farmers and ranchers. And I would say over a good portion of my career back in the day, record keeping and tax planning were not topics that filled a room. But I think that as we've had a lot of changes and other things going on and stuff, it's a good topic to, and as you can see, everybody here today, to really just kind of go over. So I work at Utah State University, but I'm part of a group that engages in taxpayer education. I'll tell you a little bit more, but it's actually funded by USDA. And so USDA has partnered with tax experts and service providers to deliver educational materials. We have some monthly webinars. In fact, Rob, you just did one, didn't you?
Business structures one last week.
So he just did business structures last week. So, and then those are on USDA or farmers.gov/taxes. They also have the agftap.org where there's some resources, and then ruraltax.org is what I'm a member of, and also Rob and Adam from Clemson University. And so why was it important for USDA to do this? And these are Sarah's slides, but many producers are new to USDA programs, and there's an increase in disaster assistance programs, other programs. They're providing funding directly to producers. And in just virtually all of those cases, those are taxable payments to the producer. And so it's important for them to be able to develop strategies and understand how to optimize their financial benefits and use the tax code. And so just as a reminder, these are some programs from USDA that can create taxable payments. And USDA will issue a 1099. 1099s are an informational form that the IRS will get a copy, and you will get a copy if you are issued one. You may also, several tax producers need to actually issue them to other people. And so they'll send a copy to IRS and to that person. And so and then the IRS uses those forms to match the payments that you have on or the numbers you have on your tax return, because they should be a taxable type thing. And so some of the programs from USDA that trigger this 1099 is Conservation Reserve Program, the Crop Disaster Payments, Assistance for Distressed Borrowers, Market Facilitation Program, and then 1098s are also forms that are issued as an informational type form. A lot of times you'll get these from like your banking account, a checking account, if you have interest on that, or some other types of things. But USDA also issues them for the Market Facilitation Program, if the farmer is classified as an individual and if the farm ownership or operating loan is secured by real estate, USDA's technical assistance is free and creates no tax implications. So normally you have the tax implications if you actually get funding of some sort or have something there. So if you do not, you should receive those in January sometime. If you don't receive your 1099 or 1098 form and you think that you should have had one from USDA, here's where you can get help. And I'm not going to read out, that contact information, but it's here. And I believe that IAC is going to post these slides or have them available somewhere too. I don't know that for sure. Contact your local IAC technical assistants and ask them. So as I mentioned before, Rob and I are part of the ruraltax.org. That's the website address and also a QR code to the website. And we are members of the National Farm Income Tax Extension Committee. I'm a co-chair of that committee. And there's a lot of different information, and that will also link back to farmers.gov/taxes. That is where USDA's portal they will link on that their website over back to us. And some weird things, not on your side, but on my side on the laptop started happening. So these are just a few of the topics, but there's a whole lot more there. My thoughts are at the end of this presentation to actually go into those websites and show you kind of how to navigate them and some of the resources there. This is just the disclaimer saying, that we're supported by USDA. It's an equal opportunity provider. We don't necessarily represent the views of USDA in anything that we do. This is another disclaimer basically saying that everything we're going to discuss is general. So when you come into taxes, there's a lot of unique things that might happen, that subtle differences at the individual level that could really affect things. And so it's important to work with your tax professional. But this is to give you some general guidance, some general information. I think it can help have better conversations with those tax professionals and also know better what information you need to really be prepared to provide to them so that they can work with you. And tax laws can change, so it's good at the time that we're doing it. So here's what we're going to cover today. We're going to go through some records and working with a tax professional, onto tax management. And then what's the potential for some tax law changes, just give you a heads up there. And then tax issues, a little bit unique to Native Americans. And just virtually a lot of this stuff that we're going to discuss today, we have additional resources and materials on those websites and webinars and other types of things. So that's why I really want to. So here's to give you kind of a broad overview. I'm going to cover a lot of territory, but then you can go back and find more detailed information on any of those topics. So I think before getting into this, it's important to really kind of think about what is the goal of tax management. And a lot of times people might say, well, it's to minimize the income tax, or I don't want to pay any taxes. But there's a subtle difference in, if you make no money, if you have no profit, you're going to probably not have to pay any taxes. But that's not really a good business practice, right? That's not really the goal of everybody in this room. And so the goal is really to have the most that you can after you pay your taxes, so that you can have, you want to maximize those profits. I mean, less the taxes. And I say that over multiple years because some decisions can really affect multiple years. And so you can take kind of everything up front and then have higher taxes to pay in the future. And so that's why we kind of put that caveat there. So we're going to start out with records and working with a tax professional. So there's several organizations that is a farming business or ranching business that you may end up needing to have records for that you interact with. Banks, lenders, Farm Service Agency, other USDA agencies, Internal Revenue Service when you file your tax return, the state departments of revenue, because most states also have income taxes and other types of taxes that you would pay. Insurance for your crop or your property that you may have. EPA, Department of Labor, other USDA agencies, and several others. So this was just kind of a snapshot, but so I'm more focused on record keeping for taxation purposes today, and just kind of some general guidelines, but recognize that there's several different groups that you may need to have records for, and so you'd also have some of those. So it's important to keep track of your activities during the year, financial, production, food safety, employee, et cetera. You have the financial ones for your revenue and expenses. A really good thing to do is to have a separate bank account for your farm account versus your personal account. When you mingle those, it becomes really difficult to then separate out what is a business expense, what is a business income coming in versus what's personal. And so it's much, much, much better if you keep those in separate bank accounts. And then reconcile the information. Reconcile just means at the end of the year, just kind of make sure everything's up to date and stuff. And then you may meet with your tax preparer during the year too. And we'll go over more of that. So how long do you keep records? This is, I think, asked a lot. And so generally, you have to keep all of your records for 3 to 7 years. Indefinitely, if there is fraud or a fraudulent return was filed, and so the IRS detects fraud, they can go back indefinitely. There isn't that limitation on that, but outside of that, it's 3 to 7 years. Property or fixed asset, 3 years after disposal. So a lot of times we are going to own property for much longer than 3 or 7 years, right? So you really need to keep track of all of those records until after you end up disposing it, it's no longer your property, and then an additional 3 years is a good practice. Major items, keep indefinitely, you know what I mean? So don't ever throw those away with some of the really major stuff. And then tax-related employee records, it's 4 years from the tax due or after the tax is paid, whichever is later, 4 additional years. But as I'm talking about on the next slide, a lot of the employee records now, because of some of the human trafficking laws and other types of things, it's actually good practice to really keep those for 10 years. And so the previous slide was more, you know, kind of what is in, you know, what's recommended as far as IRS type thing, but these are just some good practices. If in doubt, just keep it. So if your financial records, keep them for that 7-year minimum. The employment, 10 years. Financial statements, and your ownership, you know, documents, like forming your entity. So like if you have a partnership or an LLC or something, and you have, you know, information on how that was formed, you want to keep those just indefinitely. Business meetings, because a lot of times you need to go back into those if there's something that goes on in that business. And then deeds, you know, from your property ownership and things like that, indefinitely. But once a year, go through your kind of general files and make sure they're all the way that they're supposed to be, you know, close them out at the end of the year. So make sure everything's up to date, everything's there. And then kind of take those out of your current, you know, where you can really access them day to day and put them more into your storage, you know, so just kind of do that cleanup once a year. I think for your physical documents that you're keeping, like all your receipts and other stuff like that, you can buy, you know, like those totes that have like the hanging file folders that'll fit in them or something for just, I think they're probably like $20 with the lid. You can have one of those per year or something, or maybe, you know, with your records more than 1 year fits in it. But then you can just kind of take things out of like the current place where they are, you know, where you can access them all the time, and just put those in there with a label on it for what year it is, and then kind of put it off to the side in the basement, you know what I mean, wherever works for you. This is a quote from the South Carolina Department of Revenue, but I thought it really sums up kind of some of what we see kind of in the legal, you know what I mean, at the state laws and stuff. Such books or records are required to be kept at all times available for inspection by agents or auditors of the department, and shall be retained for at least 4 years after the return was filed or due to be filed, whichever is later. So in addition to what I've talked about generally kind of at a federal level and just some general good practices, there's also can be like state level requirements, and this is the state level requirement for South Carolina. So now that we've talked about kind of like how long to keep records, what information do we need in our records? And there's a concept called constructive receipt. And constructive receipt says we need to be able to answer these questions. When did it occur? Where was it? And what was purchased or sold? So here's an example, and we're showing on January 18th, $1,200 payment to the local co-op. Does that answer all 3 of those questions? We know when it occurred, right? January 24th or 18th. We know where it was. It was at the local co-op. But do we know what was purchased or sold? And so really to have complete records here, we need to actually know what happened to that. And for some places, when you see the name of the business, they only do one thing. So you kind of know what happened because of that. But for some of these others, like your local co-op, you actually had $450 for fencing, $400 for irrigation supplies, and $350 for seeds or plants. And so we actually need to separate that out and have that detail of information also. So it really kind of depends, because I've been doing some accounting for my father's estate because we're still in the middle of settling that. And so if I make a check out to the attorney, I know that was for legal fees, right? Because that's all the attorney does for the estate. But if I'm doing something more general like this, then you really need to have those additional details. And so when it comes back to it, it's really simple if you just kind of think of those 3 questions. And so as you're doing all those individual recordings, do I know when it occurred? Do I know where it was at? And do I know what was purchased or sold? And so just kind of look at what details you need to have there. As far as like record options, you can do them manual, which means just write them down on a paper. So we've kind of heard about like the shoebox of receipts. We put all our receipts in the shoebox, but a lot of times the receipts in the shoebox are not quite sufficient, and you probably need a few more details. So even carrying around, like a little tablet type thing you can keep, in your pocket or something, you know what I mean, with a pen, or in your, pickup. And then just to usually go through, just jot those down, you know what I mean, details about whatever happens, because you have that with you all the time. And that can be also your production records, you know what I mean? So many calves were born, you know what I mean? I checked I did this, this is when we started planting, this is when we started harvesting, so just kind of whatever you do, but manual is the most simplistic. Another level is Excel is a Microsoft Office. It's a spreadsheet, just generic, it just looks like a grid of boxes, but it does the math for you if you set it up manually and stuff. So you can do your own on Excel. QuickBooks is probably the most commonly used for all types of small businesses, and what probably several tax preparers are used to working with. There's also some that are more specific to agriculture, and one of those is PC Mars. And I believe that was, I know it's Iowa, but I think it was Iowa State University that was behind that one. And you can get that at pcmars.com. And so those are just some, but really the best thing about records is you need to have them. Like Zach Ducheneau was saying yesterday in his presentation in the general session, it came back to having those records, you know what I mean, helped with everything. So I'm really in favor of doing the records. Do what works for you. Don't go into it, though, in so much detail that you're going to try to keep track of every hour of every employee, of everything, of it, and I've seen people like dive in really, really intensive at first, and then after like a couple of weeks, they just completely do nothing. And so it's better to actually do something to remember kind of what do I need out of these, and what's kind of what I really need to have in those records in order to be able to get that information back out. So then if you have your records, you're going to work with a tax professional, because not very many farm tax returns are filed by the person that's filing them. Most of the times we're working with a tax professional. You need a summation of your current year transactions. And so if you have one of those accounting software packages like QuickBooks or PC Mars or something, you're able to just pull those reports from that software. Or I know like on QuickBooks, you can actually make a copy of what your records are, and then you can take that like on a flash drive, you know what I mean, or something into your tax professional. Capital assets, so anything that you sold or purchased that's not like a normal transaction. So if you sold hay, if you sold cattle, if you sold equipment, if you sold land, or you also purchased equipment, you purchased land, you purchased buildings, anything like that we've done, we need the information, when it was, what you purchased, you know what I mean, what the amount was, all of those details. You need any 1099s that you've received or sent. And again, those 1099s are informational forms, and there's information on the websites that I'll show you how to get more information on those. And you may have to have information to send out 1099s. You may do that yourself, or have the information so that you can work with your tax preparer and they will send them out for you. End of year statements from financial institutions. So like from your loans, your checking account, other types of things, anything that you receive, as end of year type stuff from especially if you've done some of those like loan payments that have a certain interest portion and a principal portion, your financial institution will be able to tell you what you paid in interest during the year, and then also kind of what is left there. So other income producing accounts, if you have anything that, brings money into you, then information on those. Any forms or documents for employee transactions or changes so that you can do those. And then any end of year information on insurance. So if anything's happened on that. So if you're working with your tax professional, then you'll probably have multiple conversations. They may say, we need this additionally, we need this or whatever. But this is just a good general list to just kind of think about, this is the type of information they're going to use to be able to do your taxes. One of the things that comes up that might make this a little bit more difficult is it a farm? So the tax definition of a farm, and you'll see that IRC and the squiggly and the numbers and stuff, you don't need to remember that, but that's, if you're working with like a tax professional or somebody else, those little squigglies and the IRC stuff and things like that, that's information for them to go find out exactly where that is in the Internal Revenue Code. And so it just tells them where to go, you know what I mean, start looking. But here's the definition from the Internal Revenue Code. A farm includes livestock, dairy, poultry, fish, fur, fruit, and truck farms. And truck farms, where I grew up in the West, we didn't talk about truck farms, but in other regions of the country, that term is really common, but it basically just means vegetables. So truck farms were people that were selling vegetables out of their trucks. It also includes plantations, ranches, ranges, orchards, and groves. So crop farms, cattle ranches, vegetables, orchards, vineyards, all of those types of things would be farming activities. And I don't have it in here on a slide, but really, if you think about it, a farming activity is to that first sellable point. So you produce hay, you can sell hay, you know, so hay is a farming activity. You produce calves, you know what I mean, those are sold. But if you convert those calves into meat, then that's not a first sellable point because you could have sold them as calves. And so you're in the business of farming if you cultivate, operate, or manage a farm for profit, either as an owner or a tenant. And this same definition applies to these other legal entities like partnerships, LLCs, corporations, estates, and trusts. This is when you're not in the business of farming, providing agriculture operations as a service. So if you're custom harvesting or custom farming, there is, or trucking of farm commodities to market. However, I want to have a little bit of a caveat there, because if we have Christy and Trent in the back row, or in the middle row, I know their names. So if Christy had a farm, but Trent says, hey, you know, can you come and cultivate, you know what I mean, for me, because I don't have that equipment, or can you come and, you know, plow my field for me? If Christy just does a small portion of that, just kind of, you know what I mean, is a, you know, with her equipment that she farms and does everything with, and this other stuff is just a little bit, she can still be in the business of farming, include that as part of her farming activities. However, if Christy buys some equipment and does a lot of that, you know, like a custom grain harvesting or custom, you know, hay swathing or, you know, baling hay or something like that, she would have a custom harvesting business or a custom, you know what I mean, farming business, and that would be separate from her farming activities. So if you just do a little bit, it's still farming because you're using all your farming equipment for it. But if you're doing a lot of it, then it could become its own side businesses. Also, if you take those farm commodities and you do something value added with them, so like the milk would be a farming activity, but cheese, cuts of meat, the wine, you've now converted those farming products into another product. And so that part is actually not a farming activity. And so it's really a separate business. And so is what you would have. And so you may want to even have like separate checking accounts for that, or a way to separate those out. And so if you had some goats that you were milking, and then you were making that into cheese, your goat milking and your goats would be a farming activity, but your sales of cheese would be a non-farming business. And so you'd have the cheese business and you'd have the goat business. And so you'd have to be able to have the goat business basically sell its milk to the cheese business and be able to separate those out. They would all end up going on your own tax return, but on different forms and stuff. So you really need to be able to have the records. So this may require additional records. So with value added, you may have more than one business. It's a good practice to keep separate records, and those expenses and receipts will need to be separated out between those two endeavors. And so the one is like a jam business buys strawberries from the strawberry business. Okay, so getting into tax management. Tax management is really a basic part of any business management practice. And it's not how to get out of paying taxes. because that a lot of times will come back to bite you. But it's really about using what's available to make good decisions about how you're going to do it. And so it requires pre-planning. And so sometimes, years in advance, in the case of, some of the estate transfer and some of those other types of things, it also requires good records. So what you really kind of think about is, I don't just want to do it at the last minute when I'm filing my return, and I need to have the records available so I can really kind of look at those things and make good decisions. And so, so your record keeping, your accounting, your tax management, they have this symbiotic relationship. They're all kind of nested there together that have to work in conjunction. And we'll tell you, I have another slide later on that goes into a little bit more of like, what's the timing for some of this stuff? You know what I mean? So how do you do that throughout the year? Building a team. So the difference between farms that are economically or financially sustainable is that they're moving from that producer farmer to a farm business manager, and they're able to kind of manage the business side of the farm and the production side, the marketing side, kind of all of those things. And in order to do all of those, you aren't necessarily an expert at all those different areas, so you may have to have a good team around you. And so some of the people that may be on that team is you yourself, the owner, the manager of the farm. Some key employees may be important for that. Tax or legal professionals that you work with, financial advisors that you may work with, extension agents, staff or faculty, crop insurance agents, your lender, your loan officer. And there may be others. This is just kind of a subset, but just kind of realize that you probably need to figure out, have that team. And then you should meet regularly with many of these at least once a year. So here we're going to go into some more details on tax management, prepays, and I'm not going to go in super big detail with all of these because there is a webinar that you can go back to, and there's also fact sheets, and I'll show you where to look at those so you can read more about this, and you can also watch a presentation. But prepays are when you purchase things for the next production season before the end of the year. So if you went and purchased some fertilizer that you're going to use in 2025 during this month, it would count as an expense in 2024. And so in order to do that, you have to have some things that need to be in place, like difficulty getting the products when needed, or you have to prove that it's a lower price by purchasing in advance. You have to have constructive receipt. You can't just say, well, I gave him, I gave the local place, my local co-op a couple $1,000s. You have to say what that was for, the actual amount that of fertilizer that you're buying or something like that, or seed if you're buying your seed in advance. And then like what seed it is. You have to have all those details there. And there are some limitations. Another tax management is, so the idea of prepays being a tax management strategy, you're really shifting the expense. If we did that in right now, we'd be shifting expense into 2024 and out of 2025. So it's just to be able to smooth your income amongst years, because if 2024 was going to be a higher income year, then we'd probably want to move some extra expenses into it. And then there would be less expenses in 2025, but if that wasn't as high of an income year, then that's a better thing to do. So it's not about eliminating taxes here, it's just moving it between years. And then depreciation is similar in it's moving it between years. So any asset that you use to produce other assets, so something that you have of value like a tractor, equipment, you're not in the business of selling tractors and equipment, you're in the business of farming, but you're using that tractor and equipment to be able to produce the stuff that you do. And so we call these assets, you're going to normally hold on to them for more than 1 year. And so the way that we allocate those into the expenses, we take a portion each year for depreciation. And so there's a difference between economic depreciation and tax. And so economic is how the market value is changing, but there's really some rules that are in place for tax depreciation. And there's options. So it's a tax benefit. You look, and the IRS has some useful lives for different types of assets. You're required to take depreciation on those business assets. And when the asset's sold, you do depreciate. And so that gets a little more technical, and I'm not going to go into it. But there's also information on depreciation. But in general, here's the options that you have. And this is why I think it's good to know a little bit more before going to that tax professional. So there's the general depreciation methods, MAKERS and ADS, and that's where the IRS has kind of predetermined how many years those should be depreciated over and what rates we do in every year. There's also rapid or accelerated depreciation options. Section 179 allows you to expense all or some of the cost in the year that you purchase it. And so instead of spreading it out over multiple years, you take it all up front. And then bonus or special depreciation, we've had different varying amounts. Right now, I think it's 60%, and it's scheduled to go down to 40% next year. So it would be like 60% of a qualifying asset in the first year you purchased it, you can just write off. And so these can really change what year you have that expense in. You can do a lot in that first year if you want, but it may or may not be good for you. Because it may be that we don't want to take it all here. We really want to save more for future years. And so this is just to be aware that there are these options. Have some conversations with your tax preparer. Be careful because, like I said, you can do all of that in the initial year, but then you don't have anything to write off in future years. And so it ends up having a higher tax burden in future years. So really just kind of be prepared. And so this is just saying, these are great tools and you can do a lot with them if you're buying, new assets and stuff, but really be prepared. Another thing is income deferment. There may be some things that you can do there with crop insurance and other things. Income averaging is it's something that's allowed for farms. And I'm not going to get into a lot here, but basically, this is a complicated graph, but you don't need to know everything here. What you really need to know that in 2022 here, it's showing a lot higher taxable income, but it shows that in the last 3 years before that, the taxable income is a lot lower. So income averaging is something that you can do with your tax preparer to take portions of that and put them back in these other years so that you can hopefully put them into a lower tax bracket. So we don't have to pay as high of a percentage of taxes on them. You may need to do quarterly estimates. And so instead of just paying it when your tax return is due, generally self-employed individuals, which farms and ranches are, must make quarterly payments. There are some special rules that are for qualified farmers. You don't have to make quarterly payments if you file your return by March 1st. So a lot of times the farm returns have to be filed by March 1st. And if your withholding for the tax year is more than 2/3, then you also don't have to do the quarterly or the tax shown on the previous year's return. So, and then if you're required to make estimated tax payments, you may make those in a single payment once a year by January 15th, rather than doing 4 quarterly payments throughout the year. You must use the number of, anyway, so is what I wanted you to mostly be aware of is not know everything here, but know again that might be something that you need to talk to about your with your tax professional and find out more information. So some good practices. So this is where I said we were going to kind of talk about, well, how do you really kind of go about doing this throughout the year? So find a tax preparer early. I think in spring before farming or ranching gets busy so that you have, kind of that locked in place. And when you're finding them, we've got some more information on that too, but ask them questions. Do you do a lot of farm returns? You know what I mean? Just find out if it's somebody that you can work with. And then in November, December, you would meet with them. And so you have to have some pretty good records that you have, that you can kind of summarize and stuff and look at that. And they're going to and together you can make some decisions about, should I sell stuff in December or should I wait until the following year? Should I pre-purchase some of those things, in December? And really kind of just decide what's good for you. In January, you'll need to send out your 1099s and W-2s to employees. And then provide your records to your tax professional. And then either by that March 1st or the April 15th, file your tax return. So that this isn't an exhaustive list, but it kind of like sets it out, as to what's happening and realizing that tax management isn't once a year. Tax law changes. these were the general rates for 2024. And so you have the standard deduction. So for a single person, you can make up to $14,600 and you don't have to pay income tax on it. If that's all from a farm or ranch business, you'll still pay self-employment tax. Married filing jointly would be $29,200. And then above that, you can see kind of these brackets, but for 12% from 11,000 to 47,000 for a single individual. And then 20, that's above that standard deduction. And then it just keeps going up as you get higher amounts. And so the idea of that income averaging was if you happen to have something like in a 22% bracket, if we can move it back to some of those other years and stay with everything in that 12% bracket instead, that would be really good, right? And so that was for 2024. These are the ones for 2025. So really similar, but they all go up just a little bit. And so every year, those rates and those brackets and stuff are going to change. So back in 2017, we had the Tax Cuts and Jobs Act, and that increased that standard deduction. It did a bunch of other things with other things that affect your taxes. And those are scheduled to expire at the end of 2025. So they're good this next year, but then it's scheduled in 2026 to expire and go back to those pre-existing levels. However, new tax laws can be passed at any time. And so I'm guessing that over this next year, you'll see a lot more discussion, like in the media, you know what I mean, and other things about what's going on with these provisions or if they do something to extend those. Tribal tax issues. Again, I've got that, we've got a article that's on the website for this, but there's some conditions that allow income from farming and ranching to be exempt from federal income and self-employment taxes for farming on trust property. This is individually allotted lands usually. Not all tribal members meet those conditions. This is just really, really broad overview, so really kind of work with your own person. This is the revenue ruling that it kind of comes back to. And so there's no right to an exemption from federal income tax for Native Americans under unspecified Native American treaty. It has to come back to that individual allotted, trust land. And so they have these tests for it. There's got to be a treaty, agreement, or act of Congress, and it's derived directly from restricted or allotted land. And so here's really the kind of the things that they look at. It's held in trust. It's restricted or allotted for an individual. It's derived directly from the land. And you can kind of see the rest of these here. If those 5 tests are not met, then the income is subject to federal income taxes. And this was some of the cases that where it came from. And then there's some other additional revenue rulings from the IRS that said this also qualifies for rents and royalties, as well as sales of crops and minerals, gains from the sale of livestock, and payments from USDA. So if you're renting from an entity that is exempt, it doesn't make you exempt. Non-farm income, so like selling rugs instead of wool, does not make you exempt. And the parcel use of trust land, you'd have to look at there's not really a guidance on exactly how to treat that. So here's where I wanted to get into resources. And I have some information up here. There's some cards directly to this page, to the rural tax website, and then also USDA's website. But I wanted to see if I could just pull those up and show you kind of those. So ruraltax.org. So here's the website. And so this just kind of lets you get directly into some stuff. So all the topics that we have, or we've also put together some landing pages with some different information. So disaster tax information, new farmer, tribal tax information, grants and programs, and we can go. And so I'm just going to go into that tribal tax. And so here, you have some information on the taxability of discrimination payments from USDA, when tribal farm tax information is exempt. And when you go into those, you actually have webinars too, or if you scroll down at 1099. So we just kind of put some stuff that's useful for that. If you go into tax topics, you can have all of them or some of those others and stuff. So there's some good stuff there. Are there any questions?
So you're talking about keeping your value add revenue separate from the farming operation. How do you account for just thinking about an apple orchard with the agritourism where you have retail and sales from bakeries and sales from corn maze trips? How do you account for that?
So the corn maze is not a farming activity. And so you need kind of that separate. If you're selling products that you've done as value added or other merchandise, that would be part of the corn maze. You know, it would be a non-farm activity and you'd want to just keep track of those things separately. But selling your apples, whether you sell them to yourself for use in something else, or you sell them wholesale, or you sell them to the public, all of that would be considered your farming activity. For labor or something, you may just want to keep it on, well, and then Robert might have a comment on that too. But for labor, you may want to keep it from like one account, but then do some type of a transfer, like, you know, 20% of it, or, you know, a certain portion of it, or a certain time of year, you know what I mean? You charge it back, stuff. Go ahead, Rob.
Real quickly, we deal with this a lot in Minnesota. The cleanest way to do that is if you've got the apple orchard with the corn maze and the gift shop and all that, create two different entities. I mean, I've seen people do this a lot. They'll make an LLC that the farm, you know, one LLC is the farm, another LLC is the gift shop, the corn maze, the hay rides, and all that sort of stuff. That's the only real way to keep it sanely separated, because what you also run into, and you mentioned it on the labor. See, the farm labor is 943, the non-farm labor is 941, and that, you know, then you get into, you know, unemployment tax issues with the state and all kinds of stuff. So just create two different entities, and you'll be happy with that.
Okay, we've got another question here, and then it looks like one in the back.
My question was about I'm getting a grant from NRCS for an irrigation system. I think they're going to give me like $18,000 to install it. Is that taxable, or is that?
Yes. However, it shouldn't create a big problem, because the money you get from NRCS is going to show up as revenue, so it's going to increase your income, right? But you should also have expenses from putting that irrigation system in, you know, when you buy the irrigation supplies and other types of things. So that's going to show up as an expense. And so your net income from farming is going to be your revenue, your sales, you know, money coming in that's for sales, you know what I mean, from sales or other types of things, less your expenses. And so if all that happens in the same year, it should just net itself out, you know what I mean, and not actually result in an increase in your income, taxable income. However, if you have all the expenses in one year and you get the money in a separate year, then that may show, you know, lower income for one year and then higher income for another year. Does that make sense? And if that's the case, then you'd want to do some tax management type stuff to see if you could do something else to kind of offset that between the years.
Good morning. I just had a quick question on if you go back to you used the comparison of the goat milk and the goat cheese, but what about like on a beef? What is the tax rate difference between us selling our live critters compared to selling processed beef to our neighbors or to our, like, what's the difference?
Sometimes we call this a Schedule C versus Schedule F. You know, are you a Schedule C business or a Schedule F business? Because Schedule F is the tax form for farming activities. And so all of your income and expenses for farming activities need to be on Schedule F. Schedule C is for all other businesses, basically. And so all of your business expenses and your business sales for non-farming type activities, so selling, like the cheese, needs to be on Schedule C. So you need to have a record. So your tax preparer is going to have to separate those out and file information on Schedule F and information on Schedule C. And they have slightly differences in how they're treated. And so farming has a lot of unique things. We file it on a cash basis and some other types of things. And so we need to be able to, your tax preparer is going to have to separate those out. And then I think Stacy's got a comment up here, Christy. You need to wait for the microphone. And so you need a record keeping system that it will allow your tax preparer to separate that out. However, if you're doing a very, very small amount of cheese compared to all your other sales, then you can still include that as just part of your goat milking business because it's just a small amount. It's when you start to have a significant amount compared to all your other sales that you really have to really separate that out as another entity. There's not anything really definite that I'm aware of. You kind of have to use some judgment. Some people take a bigger, more, I guess, risky or, generous approach to that. Other people are a lot more, it's just a little amount. So it really kind of depends. But I think, like 10%, would probably be fine. But if it's like 50%, we know that it's a major amount, right? Yeah, go ahead.
So
Stacey.
I'm going to follow up on his question because if you start filing that Schedule C, you're going to have self-employment tax. You're going to have a whole different ballgame for a business.
You're
my
gonna have
question,
self-employment tax on farm income also. So the
Right.
self-employment tax is going to be the same.
so you're going to start getting into that though. When you start that Schedule C, you have a lot more that comes into that. So if you're just doing a little bit, it doesn't make sense to file that Schedule C. And in addition, one of the things that hasn't been covered is income that is derived from the land. If they are on an Indian trust allotment, is tax exempt.
Yeah, so that's what I covered a little bit of that. And this article on the website goes into all the information we have from kind of the Internal Revenue rulings and other stuff on that tax exempt for the tribal trust lands. And I didn't go into it in detail here, but it's there if you want to go back to it and want the source code, for it. But yeah, Stacy's right. If you just have an amount that can be still part of your farming business, don't try to separate it out. But be aware if that starts to become a significant amount, and like the corn maze. If the corn maze is just small compared to all of your apple sales, it's not a problem. But if it now becomes like 40, 50% of what you're bringing in, you may have to, start to separate those. Does that make sense? Okay, go ahead.
Sorry, I don't want to use up the mic if there's anybody else, but one other question was, like a government payment, I'm going to use the LFP program, for example. If we're getting that disaster payment, it's going to be taxable. It's coming in. We've already suffered a loss of the use of our acres and grass availability. But now we're going to turn around and pay sometimes 30% tax on that LFP program payment.
So,
is there a way to offset that somehow to
So-
say that we already had our loss instead of?
yeah, so is
Taken.
what you need, so a couple of things. If it's you get the payment in the year that you had the loss, right?
Yep.
Then it's just not going to bring your income down as low as it would have. But you also got this additional funds, so you got cash in your pocket from it. And so it should, just offset what you would have had in sales from other purposes in that same year.
That's
the problem
not
is if it goes between different years.
Yeah,
And
that's
so if it goes between different years, you had the loss in, say, 2024, but we don't actually get the payment from USDA till 2025. So 2024 was a low tax year. We had a low income, because we had that loss. And then in 2025, we have a normal year. And then in addition to that normal year's income, we also have this USDA payment that brings it up a lot higher. And so that pushes you into that higher tax bracket. So At that point, the best thing to do is doing some of the tax management in 2024, like this time of year, to say, okay, what's really going on in this tax year? Are we going to be getting this from USDA? And later, is there a reason why we might want to try to do some things with like maybe more aggressive depreciation and some other types of things to kind of, or less aggressive depreciation, so we can push some of those expenses back into 2025 to hopefully offset that payment. However, if that's not really possible, then the other mechanism that's available for farmers and ranchers is that income averaging. And that's only available on farming and ranching income, not on business income in general. And that allows you to then take, it looks like, I don't know if this went to sleep or what. Oh, I guess it just went to sleep. So is what income averaging does for you. It's called Schedule J. And it allows you, and I had that one kind of complicated slide with the different bars and stuff, but it's what allows you to take that high income year where you might have additional taxable income. We want to stay out of those upper brackets. And so Schedule J allows you to take that and spread it over the previous 3 years and hopefully smooth those out and keep, those lower bracket amounts. So now you can kind of smooth that out amongst those years. And that's just for that purpose, to try to keep you out of those higher percent brackets. Okay.
I have the question on the farm and ranch exempt. So how do you know, because our farm is on our original allotment, passed down from generations. So is that tax exempt? Or when we lease from the tribe on their property, what is tax exempt on that, or do we not qualify? And we also lease from other members.
Okay, so there's some kind of things that, has some specific language in here, and I am not the Indian land tenure expert. There's others that, have done a lot more. Christy, do you want to bring the slide over to Stacy? I think she's going to have a comment. Or microphone. Okay. But there's some tests that the IRS has put in the revenue ruling to say if it's exempt. But what you're really describing is a situation where you may be exempt from that individual allotment land that you have, that you farm on, but not exempt from the farming activities you do when you lease from the tribal government or lease from somebody else. And so is what you're going to do. So there's not really a lot of clear guidance on exactly how to do that. But one thing that I have seen is we just take a proportion. So we keep all of our farm records as normal. And then they basically say, well, if 40% of it was allotment land, and 60% was land that wouldn't be considered exempt, we'll only take 60% of the income and 60% of the expenses and put those on the Schedule F. And there's a few more other things there, but Stacy.
Yeah, so it can get a little confusing. I think that the easiest way is to give you an example of my parents' operation. So they're a cattle and hay operation. My dad loves hay. I love cows. He has a few cows. When EM Farm and Ranch does its taxes, the cattle stay on trust allotments most of the year. So they do not count that income on the cattle, but you can't count the expenses on the cattle either. So you've got to weigh those pros and cons. Now the hay operation operates a lot on leases. It's alfalfa hay, triticale, stuff like that. So because there's 500 acres of leases there, whether it's from the tribe or individual allottees, that is taxable. So I think the most important thing is find yourself a CPA that is familiar with that Indian tax exemption, and then start building your operation where you can say, oh gosh, I want to keep those cows on trust allotments because I don't want to count that income and expenses. That's going to be something that's tax exempt. And then this is the operation that I know I'm going to have to utilize leases. Or if you do have to utilize leases, then make sure that you have somebody that understands that code. So if you do get audited, they're going to back you up.
Okay, I think we have time for one more question. I also pulled up the farmers.gov/taxes website, and so I'm just going to kind of scroll through here. But there's various information, and as you go down, these are actually ones where it's linking to the webinars, so the recorded webinars, so you can go back to. And then they also will have like different places, just so it's just a great resource. So ruraltax.org and farmers.gov. And I think one more question, and then I think we're at time.
Yeah, so I understand this is probably going to be a really unique issue. So I run a technical assistance program helping reindeer herders up in Alaska. We operate exclusively on public land grazing leases. And right now, a lot of those operations sort of are just done without like a formal business entity incorporation. And what we're working on right now is trying to figure out whether, for the purposes of all these farming benefits that are sort of specific to farming and we would be considered farming, is it better to go with like a single member disregarded LLC, or is it better to have the whole family involved and do, more of the standard multiple partners in one LLC? Or does it not really, does it just depend completely?
So an LLC is a limited liability company, and it gives you the benefit. It's kind of the modern version of what we set up now when we want some legal protection. So because corporations, you can only lose the amount that you have invested into the corporation because it's a separate legal entity. So if it gets sued, they can't come back to your personal assets too. If you have a sole proprietorship or partnership, which is the default, partnership is multiple people, a sole proprietor is one, you have no legal protection for the assets, your personal assets. You know what I mean? If somebody, you could end up losing personal assets in addition to business assets. So an LLC is a limited liability company, which gives you those legal protections similar to what a corporation would have. And so it's a little bit more formal entity for that. So it's for legal protection purposes. However, an LLC is taxed like a partnership or a sole proprietor. So if it's a single person, then it's like an individual, or if it's multiple people, then, actually an LLC is really taxed like a partnership regardless of how many people. And so you would fill out a tax return for the LLC because that's a separate entity. And then that LLC, though, would be pass-through income is what we call it. So it passes the income back to the individual or individuals, and then they would get K-1s and stuff, and then they would put that income on their tax returns and pay it. So the income gets paid as an individual, but the tax return is filed as the entity. Does that make sense? Okay.
One other thing.
Oh.
I did about an hour and a half webinar last Friday on business entities. It's going to be posted on farmers.gov. It takes them about a couple weeks to get the closed captioning and everything done, but it'll be posted, and that's for a free view. But that would be a good thing for you to watch.
Yeah, so you can see on here we have information. Here's one on 1099s. Working with a tax professional, how to find a tax preparer. There's also some of these other hurricane issues. And so basically, and it said view all tax videos, so Rob's would end up being here. And we also have those all on next to the, usually we have them also posted on ruraltax.org. So I've got cards up here for USDA's farmers.gov/taxes website. I've got little cards for rural tax. I also have a card that has the link directly to the tribal tax page that I pulled up. And also there's one on disaster assistance too, because that always comes up and we have a page on disaster assistance. So the bigger cards are for those. The small card is just a rural tax. And then the green handout is for USDA's farmers.gov/taxes. So those are all, those should get you to all of better resources than what I've kind of gone over today on just about every topic that we went over, I believe. So thank you for being here.